All right. Good morning, everyone. My name is Chris Paulson, and I am a regional director here at Golden Care, and I would like to welcome you all to our presentation today on the unique tax advantages of traditional long-term care insurance. I have the pleasure of introducing our featured guest today, Stephen Alloy. But before I do, if you are not contracted with us or want to learn more about Golden Care and the products and services that we offer, please visit us at goldencareagent.com or call our marketing team at 1-800-842-7799. We offer competitive commissions, a diverse portfolio of senior life and health products and carriers, including Mutual of Omaha Long-Term Care and the full suite of mutual products. But most of all, we provide world-class agent support and service to our agents every single day. Reach out to us to find out more. Today, I have the honor of introducing Stephen Alloy, an advanced marketing specialist with Mutual of Omaha. Stephen has an accomplished and impressive resume, having practiced law and works in the financial services field too. He has 40 years of experience in the industry and has been in the advanced markets with Mutual of Omaha for 14 years. Stephen, along with the whole Mutual of Omaha team, we really value their partnership with Golden Care, and we work together every day to help our agents succeed. Today's topic is very unique, and I think we'll turn some heads. Before I say too much, I'd like to introduce Stephen Alloy.
Well, thank you, Chris, and thanks everybody. I'm really glad to be able to talk to you today. I am actually still I'm having the pleasure actually of addressing you from the closing moments, I guess, of the ILTCI conference in Raleigh, and had the opportunity to spend some time with some of the Golden Care people. That had some beers with Tom last night, in fact, and I can say you've got at Golden Care, you've got a very intelligent, very dedicated team helping you. So you're in the right place. You're doing well with Golden Care. Always glad to work with you guys as well. And I was telling Chris on this topic. I'm glad to talk about this topic too, because normally in, say, on the life insurance side, we get a lot of questions. Hey, can I deduct this? Can I deduct that? Usually the answer is no. But good news is we'll talk about today, long-term care has some nice yes answers. You can deduct, a lot of different things, have some tax advantages. So let's talk about some of that. The first one is that obviously the benefits is, probably all of you know, benefits are tax-free. They're treated as, health insurance benefits. Tax-free accident and health insurance, and that's all under the HIPAA Act that became effective in '97, but actually policies that had been issued prior to that date were grandfathered. So pretty much any policy you're going to see out there would be covered, would be considered health insurance, would be taxed accordingly. So basically what that means is the benefits, typically the reimbursement benefits, at least I should make that clear. We'll talk a little bit about that in a second. But the reimbursement benefits do come in tax-free. The question we get on deducting premiums has a good answer with long-term care. Not so good on life insurance, but it's got a good answer on long-term care. What you can deduct though, and how much you can deduct depends on who's paying, who the person is or the entity is. It's either individuals or businesses, and within individuals, you can differentiate between employee and what they call self-employed, which actually covers a ton of businesses as well. So let's go into some of the specifics on that. For employees, let's start with that because that's in a way the simplest and quite often the most common that you run into is the insured is an employee of a company and they're paying their long-term care premiums. That individual can deduct up to the eligible premium. And you can see these are age-based eligible premiums. Usually, the note says that it's subject to annual inflation adjustments. For whatever reason, the age 61 to 70 went down $10 from last year to this year. I'm not sure why that happened, but typically they do go up slightly. They really don't go up too much year to year usually. But this is how much an individual can deduct, or can, to clarify, can apply toward the medical deduction. because that's really how an individual would have to deduct it. And I guess to explain on the medical deduction, those premiums count as unreimbursed medical expenses. So any health insurance premiums, any out-of-pocket medical that wasn't covered by regular health insurance, all that can count toward this the medical expense deduction. Under current tax law, you've got to have medical expenses that reach or exceed, actually, you can only deduct what exceeds it, but it's got to reach at least 7.5% of the taxpayer's adjusted gross income, or AGI. And in order to get that deduction, the taxpayer would have to itemize on Schedule A. Now, a lot of people never itemized. The Tax Act from a couple of years ago, this is just a Schedule A. The Tax Act from a few years ago, from 2017, really made it so that even fewer are itemizing now, because basically what that did, that increased the standard deduction, basically doubled the standard deduction for a period of years. So most people, unless they've got a lot of unreimbursed medical, or they've got a lot of interest on a home or some other kind of big item that they can deduct, most people are going to find themselves under the standard deduction. So unfortunately, a lot of people don't itemize, but in order to get the specific deduction for the eligible premium on the long-term care, you would have to itemize. Joint Committee on Taxation estimates that 9 in 10 use the standard deduction. I'd say it's somewhere between 9 and 10. I think it's more than 9, but obviously not everyone, but it's most. It's the overwhelming majority. All of that is scheduled to sunset at the end of 2025. So don't really know yet if that's going to happen even, or if there'll be some changes even before that. But at least as it stands right now, that's how an employee would have to deduct the long-term care premium, and they'd be able to deduct the eligible premium. So for business entities, it's a little bit different. Business entities basically consist of C corporations and everybody else. Because C corporations are, as we'll talk in a minute, they're kind of the tax darlings of long-term care. But let's start with self-employed, because I think that's more of the people you're going to run into would be considered self-employed. The self-employed, for purposes of deducting long-term care premiums, literally includes every business other than a C corporation. So it could be a sole proprietorship, it could be an LLC, as long as it's not taxed as a C corp. It could be a S corporation. It could be just somebody doing independent contractor work. It would be sole proprietor, I guess. Any of them can deduct the eligible premium, but they don't have to they don't have to add it to the 7.5. They don't have to reach 7.5% of their adjusted gross income in order to deduct. So they're still limited to the eligible premium, but they're not, they're more likely to be able to deduct it in the sense that they don't have to reach that 7.5% of adjusted gross income. And again, it's treated as self-employed health insurance premiums, and it's deductible up to the eligible premium. And you can see it's on, you carry it over to 1040, to the 1040 form, but you'd actually claim it on a separate form here. Now for C corporations, if you run into C corporations, you should sit down and talk, because they have kind of the best tax picture really of any entity with long-term care. They can actually deduct C corporation owners who are also employees. Now, they can't be an absentee owner, but if they're an owner employee, they can deduct the eligible premium on themselves. They can deduct they can deduct the actual premium on themselves. They can deduct the actual premium on spouse or dependents. That premium doesn't count as income to them, and the benefits are still tax-free. That's, really doesn't get a whole lot better than that as far as taxes. So that's a pretty good pretty good story for C corporations. Long-term care, a lot of people will say, well, hey, I'd like to, a lot of business owners, they say, well, I'd like to provide this for my employees. I don't necessarily know that I want to provide it for everyone. Long-term care is one of the few benefits that you can be selective on. You can provide it to some employees and not all. You know, you can carve out, say, if you want to provide it to the the top executives in the company, or you know, people in a certain category, and not to everybody else, you can do that with long-term care. I think if someone's going to do that, they should certainly work with counsel. You do have to be a little careful. It's you know, it is not generally subject to the ERISA rules, but unfortunately, sometimes the way a company might structure it might bring it under the ERISA rules. So you do have to be a little careful with that. But in general, I mean, as a general rule, the companies can select out certain people and say, hey, we're going to give long-term care coverage, we're going to provide it for these employees, but not for everyone. So again, this the best tax treatment of the three, this is kind of just covered this here, but can deduct the actual premiums paid for the employee, and this is, you know, even let's say if a C corp is providing it for their employees, they can deduct the actual premium, the employee's spouse, dependents, doesn't include it in income, and benefits come in tax-free. So again, a pretty good result. So C corporations really should be, you know, you run into a C corporation, that's really where, that's the long-term care conversation right there. The long-term, the benefits are tax-free as long as they don't exceed the greater of actual expenses or what's called the per diem amount. Where you've got reimbursement policies, typically that doesn't become an issue because they're only going to pay based on qualified long-term care expenses. So that's not really an issue with those. But where you have cash policies, where you take the cash and use the discretion, just use it at their discretion, you may run into the per diem issue with that. The per diem issue for this year, for 2022, and again, I'm not really sure why it went down $10, but it went down $10 from last year. So if someone's doing their taxes for 2021, they would use that $400 per day, which that works, that's about 140,000 per year, something like that. For 2022, for this year, it's $390, which is actually it's still about 140, but you know, it's $10 less per day. That would be the amount that someone can receive tax-free on, say, on a cash policy. But you know, again, if it's qualified long-term care expenses, it could be, you know, more than that per day, and you'd still get the benefit tax-free because that's a qualified reimbursement. So sometimes some of the tax questions go into, you know, other plans and say, hey, can I pay my long-term care premiums from my HSA? Yes, you can. Can I pay it from an MSA, medical savings account? Yes, you can. Health reimbursement account? The answer again is yes. So those are all pretty good. Now, doesn't necessarily stay with yeses, because can I do it from a flexible savings account? No, unfortunately, nor a cafeteria plan. In fact, at this conference, that was one of the discussions, is that might be a solution to the long-term care problem, is make it available in cafeteria plans. Well, you know, that'd be a nice solution, but as of now, you can't do that. I think the reason for that is that a lot of that money would go in pre-tax, and then you'd be theoretically able to deduct the premium as well as using pre-tax dollars. So I think that's why, but at least as of now, that you can't do it from flexible savings accounts, FSAs, or cafeteria plans. Now, the Pension Protection Act a few years ago did allow for 1035 exchanges from life policies or annuities into long-term care policies. that's good, but unfortunately the implementation on it hasn't happened to a large extent. One of the problems with it is that if we still had single pay or short pay policies out there, that might be a clearer case. Certainly a single pay, I think, would be a pretty clear case that yes, you can definitely do a 1035. One of the problems is that it's never been clear if you could do a 1035 as a series. You know, if you can do like an annual premium, you do it as a series. Some carriers have a workaround on that. They'll put it in, they'll do a 1035 into, you know, a SPIA, and, you know, pay from the SPIA. So I mean, there are a few carriers that work around it. You know, a lot don't. Probably more don't do that than do. You know, I know at Mutual we were, well, in 2009 this issue came up because the act became effective, I think, in 2008. And in 2009, the IRS said, yeah, we understand that you need some clarification on that, and we'll get you some clarification. Well, I guess they've been busy since 2009 because we haven't gotten any clarification yet. So that as we stand now, it's yes, you can theoretically do it, but it might be hard to actually do it. I mean, I think there maybe are still a couple of carriers. I know there were a couple of carriers that were doing it. I'm not sure anybody still is though. So, but in theory, that is allowed. So a lot of times in advanced markets, we get questions on return of premium, and the return of premium certainly in like life policies where you haven't been deducting the premium, clearly it's just a return of your own money. It's not a taxable event. You get that tax free. Long-term care is a little more complicated because you may have been deducting the premium. So it is tax-free to the extent that you haven't deducted it. So for example, those individuals, those employees who aren't itemizing, they have never deducted their premiums. So it's probably all tax-free. Somebody who is allowed to deduct the eligible, but has a policy, has an actual premium that's much higher than the eligible, well, the eligible isn't going to be tax-free because they've already deducted that, but anything above that they haven't deducted and weren't able to deduct, that would come back tax-free. So it's a little more complicated, but in general, anything that wasn't deducted would come in tax-free. The medical gifting rules allow, and just in general, you can gift someone's medical expenses, and it kind of takes you out of the gifting limitations. If you're gifting now, the gift has to go directly to the medical provider. If someone wants to gift long-term care premiums, they can do that, but they're limited to the eligible premium. So anything, if the eligible premium is, or if their gift would put them over the annual gifting, which is $16,000 this year, then it would either be considered a taxable gift, or it would have to come off their lifetime gifting. But if the eligible premiums are pretty close, I think, in a lot of cases to what the actual would be on a lot of plans. So, it's probably quite likely it's going to be a non-taxable gift. So someone can gift the long-term care premiums to someone else. Some states, so far we've talked all about federal taxation, but some states have incentives to take up long-term care because they realize that people are going to need this, and if, to the extent they don't have it, that's going to become a state expense and a federal expense at some point too. So a lot of states have incentives, tax credits, which are it's even better than a deduction, because if you get a tax credit, that's literally a dollar for dollar reduction in the amount of tax you owe, not reducing your taxable income. So that's pretty nice. A lot of states do that. So you can check, there are different organizations that kind of keep track of this. AALTCI, I know, is one. I know they've watched this for years. So, but keep track of that in your state, because a lot of states have really very attractive state benefits as well. Now, that state benefit is only going to help you on the state income taxes. So typically a state that doesn't have a state income tax may not have an incentive because there's no state income tax, right? So, but the state that does have a state income tax, it's definitely worth checking because a lot of them have some really nice benefits. And speaking of states, I'm sure everyone's thinking about the Washington state law that passed last year. Was supposed to become effective by now, but early in January, the legislature in Washington decided to delay implementation until July 1st of 2023. There have been lawsuits. Some of the legislators realized, hey, we didn't clarify some things, like, for example, they didn't define long-term care. So that's one of the things they didn't clarify. So there are some fixes that they realized they needed to do, and as if to prove that they realized, hey, we need to fix this. The very same legislators, this is the same group that passed it last year. I mean, same people. They voted 91-6 to delay it. So gives you some idea. I think they realized, hey, we got to clarify some things first. So I mean, that's on hold right now. Now, this delay in implementation doesn't mean it's going away. I mean, it's probably not going away. And I think the real key with this is not only the state of Washington, but I think Washington is, I guess, for want of a better analogy, they're sort of the canary in the coal mine. I think a lot of states are watching Washington right now. I know California is. In fact, interestingly enough, they have a committee that is doing a similar law in California, and their committee is scheduled to report right around the time this implementation goes off. So, I think a lot of states, and they're not the only state that's watching it. So I think what that would mean for those of you that live in Washington, you're well aware of all the issues going on, but those that don't live in Washington and think, well, that's doesn't really apply to me, I think it might, because a lot of states are looking at doing exactly the same thing, and to the extent they do it, if they model the Washington law, they will have an opt-out if someone already has long-term care insurance. Now, the Washington opt-out, now they're delaying implementation, but they didn't change the date that you had to have the long-term care. So they're not going to implement this for another almost year and a half. But you had to have the long-term care by November of last year. So if someone says, hey, I want to opt out now, it's like, oops, can't do it. And I think that's something that could happen in a lot of other states as well, where maybe they don't have an opt-out, but if they do have an opt-out, the coverage might have to be in place before somebody really kind of knew that it was going to be a problem. So I think the next couple years, the next handful of years as this rolls out to different states, could be a real great opportunity for long-term care to get that coverage in place, because I don't want to go into too much details on the Washington state law. I actually have another presentation on that, but I guess it's better than nothing, but it's really not, it's really not going to cover much. It is going to delay Washington needing to put these people on Medicaid for about, for a few months at least, maybe a year, but it's not really going to cover real long-term care costs. And I think, unfortunately, a lot of what we'll see in other states would be about the same. It's a delay in putting someone on Medicaid, so they get maybe another year of not having to pay Medicaid. So, okay, and that's why I think a lot of states are going to start looking at this. Even states that you wouldn't expect would go for this. I think at some point, because every state has the same problem, and I think they're going to start looking at this and going to say, we'd rather not do this, but we got this Medicaid problem. So what do we do about that? Well, I think a lot of them are going to come around to doing something like this. So I'd say the next handful of years, maybe as long as 5 years, is a real golden opportunity to get good coverage, real coverage in place for people so they're not stuck with, whatever, with paying a payroll tax. This is funded by a payroll tax, so they're not stuck with paying a payroll tax and really not having good coverage for it, and say, well, I still need coverage, so I got to pay the payroll tax and the premium now. So I'd say now's a good time to start talking to people in any state about that. Certainly, if you're in California, New York, Illinois, some of the states that have started advancing this, yeah, oh yeah, definitely time, but really any state. Another great tax benefit from this is if you've got clients that are part of a retired public safety employee retirement plan, they can actually, I mentioned earlier how typically tax law won't allow pre-tax dollars to be used for something that could be deductible. There's one case where they will. They can take money up to $3,000 from that plan, which is all pre-tax dollars to them, but they can take that and pay the long-term care insurance. Now, I don't think they can deduct the premium again once they do that, but they can use pre-tax dollars and really not out of pocket, because it's in a plan that is not part of their lifestyle expenses yet. So it's kind of a nice benefit. Now, it only applies to a limited group, but if you've got somebody in that limited group, it's a pretty nice benefit. It applies to police, fire, and other like rescue squads, chaplains, and stuff that work with police and fire, EMTs, things like that. So if you've got someone like that who's part of one of these plans, that could be another good opportunity as well. Partnership program is, as you guys are all probably aware, is something that is sort of a state compact, and it's really an asset protection strategy. I think long-term care in general is an asset protection strategy, but the partnership program really enhances that, and it's another incentive, another proof that states and the federal government are saying, we got to do something. We're going to have this problem here with like all these people that are going to need care. What do we do? So they created this incentive to protect assets, up to the amount of coverage. So I'm not going to go into a lot of detail on that, but because you guys probably have already gotten trained on that, so I'm not going to go into a ton of detail. But that's a very nice asset protection strategy, and I think it helps answer the question when someone says, "Hey, but I can afford to self-insure." Well, first of all, most of them really don't know what that's going to mean, so they may not be able to self-insure. But you may run across somebody who has plenty of money and maybe could self-insure. The question would be, well, why? Why would you want to do that? Why would you want to use your assets for that when you can protect them? Not only protect them with the insurance, but protect them through the partnership program as well. So, it's kind of a nice answer to that question. And gosh, this is us. We're through the slides. This is our advanced markets department of mutual. Well, I've aged a little bit since that picture. I probably need a new one. But anyway, we're certainly glad to help. You've got a great team at Golden Care, so they can probably help you more. In some ways more than we could. But we're glad to help you. Certainly, if you have any questions that we can assist with. And I don't know if we got some time here. I don't know if anyone has any questions now. I'd be glad to take them.
Yeah, thanks. I really appreciate it. Great job. It looks like we have one question.
Oh, sure.
All right. So I'm assuming we're framing this from a tax perspective. One of our agents here at Golden Care asked, why traditional LTC instead of a hybrid?
Well, that's a good question. I think I personally have traditional, but I'm not anti-hybrid. I think they both serve a purpose. I kind of like the traditional just because it's depending on the rider with the carrier. You might get a little more flexibility with the standalone, with the traditional. Another reason, and there's a tax reason, is that with a lot of the riders, and unfortunately, including, we have a long-term care rider on our IUL policies as well, and unfortunately, that can't be deducted because it's filed as part of the life product is not differentiated from the life premium. So
Right.
the cost of that rider can't be deducted. Whereas certainly if you do standalone, that's clearly long-term care, clearly health insurance, that can be deducted. I think there are a couple carriers that filed separately that you can deduct. They will break out the premium cost, but a lot of them won't. And there'd be a tax reason maybe to choose the traditional over the rider. But for some people, the rider is going to make more sense. If they're getting insurance anyway, life insurance anyway, the rider can work for a lot of them. But from a tax perspective, the standalone might be better.
Gotcha. Thank you. And to that point of the LTC rider, we have another question that is referring to just that. What is the tax deductibility for the LTC rider in certain situations, in parentheses, the hybrid policies? I'm sure that she's referring to.
Yeah, and we just kind of covered that briefly, but for most carriers, and it's really a question of how the product is structured and how it's filed, how it's registered with the states. Most riders, I think, are like ours, and it's lumped in with the life and can't be broken out. I know there are a couple that I've heard of, a couple carriers who did break it or will break it out, or they filed separately. They filed it as a separate product, if you will. So there are a couple that will, but by and large, you kind of lose the deductibility of long-term care by doing the rider.
Gotcha. Thank you for that. Let's see if we have any more. Looks like that's about it. Well, thank you, Stephen. Great job. Really appreciate it. I learned a lot, and hopefully everyone that joined us today did as well. There are a lot of reasons to get long-term care insurance, obviously, but knowing that individuals and businesses both have tax advantages, in addition to those long-term care benefits, it just has to be brought up. It's just, our clients need to know that this is an option, and there's a bunch of reasons why. So if you're on this call and you're not offering long-term care to your clients, give us a call today, and we can help you change that, and you can make a big difference in your clients' lives. So feel free to reach out to us here at Golden Care at 1-800-842-7799. Or you can go to our website at goldencareagent.com, and we'd be more than happy to help. So thank you again for your time today, Stephen, as well as everyone else that joined us today, and hope that you all have a great rest of your week and a great weekend.
Great. Thank you. Thanks, everyone.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.